A few years ago, I lost about 50% on my investment for AQN, Algonquin. I remember that as it was yesterday. I sure don't want to live that again, and I'm sure it's the same thing for you. So today, we're looking at telcos, REITs, and utilities and trying to understand why in the world they do not follow the stock market right now. Fellow investors, bonjour! This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Gold investors, bonjour, Mike Leroux here. After reviewing a bunch of quarters, today we're going to focus on three specific sectors. Vero, are you ready?
I'm ready, Mike, and I'm like definitely ready for your answers because I've got a lot of questions for you. So telecoms, REITs, utilities have all been down for a while now. It has even become confusing to know which company to buy and which one to sell because they are all basically crap if we look at numbers. So this is what we will look into today.
Yeah, the overall stock market is actually doing pretty well in 2024, following a good year in 23 as well. But those sectors specifically, they just refuse to participate to the party. They're really they're sitting on the side and they don't want to drink anything. They hate the music and they just want to go home. And as investors, I don't know what's wrong with us, but we keep on saying, oh no, come dance with us. It's going to be fun. So what's wrong with those guys?
So, of course, listeners, you should not consider the stocks we will mention today as buy or sell recommendations. You must always do your due diligence.
I'm gonna stop you right away here. For the due diligence, we just had an episode last week about how to review the quarterly earnings. I think it's a must, especially for those sectors right now, because man, there's a lot of things going on. So please, it's fun to talk about them today, but do the work, dig into financial statements. Those are examples of companies that you will have to spend hours to understand what's going on.
Right. So if you want to go back to that episode, I will put the link in the show notes, or you can also go to thedividendguyblog.com/190. So of course, Mike, let's start with the telecom industry. Why is it such a difficult time for them?
Yeah, so for the telecoms in general, they will have wireline, wireless, and media divisions. That's pretty much the overall package. Sometimes it's going to be not media, just wireless or wireline, but it's about things. The problem is, the first one is if you have media in your divisions, well, it's very tough. People are not watching cable anymore. It's cutting down. It's really tough to generate revenue growth and earnings growth from those. The advertisement spending is actually moving elsewhere, mostly online with the Facebook and the Google of this world.
Mhm.
So media is battling to get to keep that piece of the pie that they had, which is pretty tough. The wireless on the other side is great because we all need cell phones. We use more data every day. So that's great. But it takes so much capital expenditure to maintain such great network across Canada, across the US. And then if we look in Canada more specifically, on top of that, they're already charging so much and the government is watching over them now to not increase it. So it's tough to generate revenue growth from the wireless industries for one of that reason. And of course, if you're spending more and more, well, you must generate revenues to back it up. If not, it's going to go into the debt. So a lot of telecoms have borrowed substantial amount of money over the past 10, 15 years with the promise that they will generate more cash flow going forward. Well, we're kind of at this moment where investors are just yeah, dude, where's the cash flow? Because, we want to see some growth here.
Mhm.
And with the interests that are higher up now, it's getting tougher and tougher for this for this industry to, on one side, they struggle to generate higher revenue, and on the other, their expenses bill are getting higher as well. So the margins are getting squeezed, and this explains why a lot of investors probably just decided to move into another sector.
Mike, you have never been a huge fan of the US telcos. Has anything changed for AT&T and Verizon? And would you buy or would you sell them?
Yeah, asking the question is pretty much answering, right? Yeah, so of course, for the sake of the episode, we cannot go for all the telcos. So we decided to pick like two major players. They're paying dividend as well. So let's start with AT&T, which reminds me of another version of Bell. A lot of Canadian investors are telling me that Bell has been there forever, and they're like incredibly solid, and they're paying like they're having a lot of cash flow to pay their dividend, which was exactly the case for AT&T for several years,
Mhm.
and they ended up making bad decisions, more specifically trying to expand towards the media business with the acquisition of DirecTV a few years ago, which was a big mess to be nice. And they eventually, well, they fell with the media, and they eventually spun off Warner Media, cut their dividend, and since 2022, nothing else happened for the dividend payment. So of course, it. I mean, there's not much bright lights at the end of that tunnel. It's pretty much just going downhill from here. I'm not saying that they're going to go bankrupt, but as an investor, I'm not really excited.
Mhm.
We had a brief moment where we thought that things were going the right way. So they racked up a lot of debt for the DirecTV acquisition, as I said, and they were
Mhm.
generating more cash flow. It was before COVID, and it seems like stuff would have played out, but eventually, we know how it ended up, and that cash flow didn't last long enough, and they just realized they were just good at the wireline and wireless business. The media was not the future for them. Now they're going back to their origins, which is a good thing. But as an investors, I will require a lot more than a good story. So now you have like an interesting narrative, but the numbers are not following. So as long
Mhm.
as the dividend triangle is weak, so we don't see really much revenue growth or earnings growth over the past few years. We're not even going to talk about the dividend here. So it's like three streaks, you're out. There's nothing else on my side here. I don't find anything interesting at this point. Moving on to Verizon, it's a little bit better, but I really see that as a dividend trap. I mean, to be nice, we could talk about a deluxe bond where the company generates a lot of cash flow. They're paying a nice dividend. It's increasing a little bit, and you should not expect to see the stock price moving much or maybe going down a little bit. So, nothing great here once again. But I mean, the thesis is great. I mean, they spent like a lot of money building like a great fiber network in major metro areas. They have like they acquired so much wireless spectrum to increase their network capacity. They're everywhere. They have good coverage. They have good customer service. They have good performance, but yet they face stiff competition. Everybody's like battling for the same customer with the same cell phone plan.
Mhm.
The fixed line business costs a lot and does not generate much profit either. And at one point they get to a level where the company must decide if they keep on spending or they have to face the debt that they have been building. And at one point they will have to pay it off, at least partially. But when they do that, it means like less cash flow left on the table for more investment and of course for more growth or more dividend. So they're going to be trapped there paying down their debt, being a good company, but I don't see like an amazing future for like either AT&T or Verizon. At
Mhm.
best, they're going to keep upping the dividend with minimal dividend growth. That would be the best case scenario in my opinion.
All right, so the Canadian options used to be better choices. However, things are turning sour for BCE and not going so well for TELUS. Do you still see a positive future for them?
Well, BCE, they seem that they act like irresponsible parents spending more money to please their children. when they don't have it. So it's really like, oh, like children, we're going to go to Paris because it's going to be fun. But dad, you just lost your job. Yeah, don't worry about that. It's all good. I mean, we have credit cards. So they and that was my interpretation of the CEO saying we're going to increase our dividend 3% in 2024. I'm like, why in the world you do that when all your cash flow metrics suck? Like they are bad. They show high payout ratio. They struggle to generate revenue. I don't know. I've been patient enough now, and I of course monitor this one every quarter, but they're not. The narrative doesn't change, and the numbers surely don't change. So yeah, it is getting close to be downgraded at DSR. It's already like rated as an old. At this point, we're really getting close. We're gonna wait another quarter just in case they can pull out some magic. But I'm getting at the end of my patience here. It's been like 2 years, and for those who's gonna tell me, oh, but Mike, interest rates are already started to decrease. I'm like, yeah. They're not going back to 2019 level, like not tomorrow morning for sure. Anyway, so this year in 25, potentially in 26, all the debt that will be renewed will be at a higher interest rate than it is right now. So this means that interest charges are going to keep on going up. That is one problem. The second problem is they struggle to generate stronger revenue growth. So if you cannot sell more and your expenses are going to increase, what's going to happen with your earnings, with your cash flow, and with your dividend? They're going to get squeezed. So that's pretty much what I see right now. So yeah, not super happy with what Bell does, and not super optimistic. And when I look at the numbers, I don't see like where's the bright light here. For Telus, it's a little bit better. But again, I'm starting to get frustrated. I own shares of Telus as opposed, I don't have like shares of AT&T, Verizon, or BCE, but I do have Telus in my portfolio. And what I like my investment thesis about this one is, first, I really like the fact that they were generating most of their revenues coming from the wireless business, which is the most profitable in amongst telecom. And I really like their growth vectors across Telus Agriculture, TELUS Healthcare, and TELUS International. The problem is over the past, I would say about like 18 months, 2 years, those three growth vectors are actually not growing. So this is where you can see, oh, you have an investment thesis. So you have a story about how that company could grow. But when you look at the numbers, they're telling you that you're wrong. And it's okay to be wrong for 1 quarter, for 2 quarters, for 3 quarters. But at one point, I mean, it's getting redundant and it's not going towards the right direction. So while the payout ratio is better, the cash flow metrics are better than Bell, at one point, it's going to be tough to continue to be optimistic for Telus. So I still have it in my portfolio. And in a few months ago, I mentioned that in one of my newsletters for DSR members, is what I do with companies that, I mean, I'm still making money on my investment because I held Telus like a while ago. I bought Telus a while ago. So if I sell tomorrow morning, I'm still going to make money. Not a huge pile of money, but I'm not losing anything. I got the dividend during the meantime. So it overall was not a bad investment, even though hindsight, of course, is always 2020 when you look at the past. Even though if I had sold like 2-3 years ago, I would have made a lot more money. I'm not in that position where it's going to be difficult because I'm losing. However, at one point, you have to determine for how long you're ready to hold on to a company that present numbers that do not align with your investment thesis. So in that newsletter, I explained in my process that I'm usually willing to wait 2 to 3 years. I mean, we're talking about like huge businesses. They cannot turn on a dime, and they are actively doing stuff to make it better, of course. Sometimes it works, sometimes it doesn't, but it takes time to make it happen. So for Telus, this year in 24, I'm happy about the improvement, but we're definitely not there yet. So I'm going to hold on to those, but at one point, I need to see better numbers.
And Mike, are there any telecom companies worth buying, or has it become an industry to avoid, or just maybe like move on to Meta and the likes that will probably pay a dividend soon?
I'd say like you can have like a small portion of your portfolio. Again, it's always about like diversification, right? So I'm not going crazy about my Telus shares because they're about like, I don't know, like 3-4% of my portfolio. So if I sell them tomorrow morning, it's not the end of the world. And if I don't sell them, it's not the end of the world either. So I'm okay to keep those right now, but it's going to be a tough ride, and I know that. So at one point, I need like better options for Telus. As for the others in the telecom industry, we didn't talk about like T-Mobile, for example, in the US, or Rogers and Quebecor in Canada. But I don't see them as interesting because they're in the same industry. They face the same challenges. So it's going to be very hard. So at one point, you don't have to be exposed to all industries. Anyway, it's impossible because if not, you would just have to buy an index fund, an ETF. So in the end, I would say if you don't have any money right now in the telecom industry, it's probably not the worst decision you have made so far this year. So you can go on and just make sure that your exposure to risk, considering this sector, is not too big, even though they pay a super yield, because that's not a reason to hold a stock.
Mm-hmm. Okay, so let's move to REITs. Again, interest rates have greatly impacted them. What else is hurting the sector?
So of course, if you want to run a successful real estate business, it will go through leverage. So you remortgage your properties, you buy more, and you build up a huge portfolio of properties. When interest rate rises, well, you have a problem because then and the biggest problem that we have right now is interest rate rose a lot faster than the REIT's ability to increase their rent. So
Mhm.
yes, they are able to increase rent, but I mean, they were not able to increase it as fast as interest. It is also a slow and boring sector where slow is super important to understand here. It's really difficult to turn your business around. I mean, if you have an apartment building or if you have your warehouse, you rent it and then you wait. That's pretty much the whole
That's the
business model
goal.
here. Yeah, that's the goal, right? It's like it's kind of like the definition of passive income. So when you
Mhm.
need to change something about your business model or modify something, it's also a lot harder because we're talking about brick and mortars, and it's hard to just, I'm going to turn around this this office building into apartments. Yeah, sounds good on paper. Now you have to hire like contractors. They have to destroy entire floors and rebuild it completely because an office has not been built the same way as condos. So if you want to have like all of a sudden like a dozen of bathrooms on the
Mhm.
same floor, well, this is not what you had back then. So you need a lot of investment to be put in to convert an office building that was empty into apartments. So all of those modification takes time, and it's really hard for investors to guess if it's going to be a successful turnover or not.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you. So please spread the love. Thank you. So on the sell side, we have Slate Grocery, sgr.un.to, Plaza REIT, Plaza Retail REIT, plz.un.to, Crown Castle, CCI, and Macerich, MAC. Why should investors let them go?
So let's start with no dividend increase, no dividend increase, no dividend increase, and a dividend cutter. So at least there's one that cut the dividend. They did something, right? But yeah, no. And then you're going to say, but Masterich increased their dividend not too long ago. I'm like, yeah, after slashing it like big time a few years ago. So they have not recovered. And until a
Mhm.
company have not recovered its previous dividend level, I'm going to call it a dividend cutter. Even if they increase it but 5 times, if they have not increased it to the previous level, it's a no-go for me.
Mhm.
So now, in more details, and I wanted to talk about Slate Grocery because this one is really counterintuitive when you think about that. Slate Grocery focuses on having properties that have grocery businesses anchored in those properties. So how in the world they could not make money when their largest tenants are grocery stores? Everybody has to eat, right?
Right.
And they're
Right.
all everywhere. And like when we look at grocery stores, they're far from going to bankrupt. Most of
Mm-hmm.
those chains. So what's wrong here? Well, it's all about how it's being managed, I guess, and how it's being shaped, because they are not growing, and even worse, the funds from operation barely cover the dividend. So we are close to 99% right now of AFFO payout ratio. So when you have high yield, no dividend increases, and all your money is going towards the dividend payment, what's left? Well, dividend cuts. That's
Mm-hmm.
pretty much it. I mean, it's like the signals cannot be stronger than this. So I don't care about the business model where it's really seductive. The narrative here is amazing. I mean, I would have like I wouldn't mind like owning bunch of IGA's stores, and they would just like, yeah, I mean, they run there, and people are buying their grocery, and I'm going to just cash in the checks. Well, apparently it doesn't work that way. So even though it's
Right.
simple and it's seductive in your mind, there's a few problem here. Plaza REITs, again, Plaza Retail, same problem. Payout ratio is above 100% right now. No dividend increase since 2018. So again, what do you need more? I mean, it is not doing well. It's just, I don't get it. It's like, if you would compare Plaza REIT to like a personal finance, it would be like someone making $100,000 a year net and having like $105,000 net of expenses. Not going to happen. Not going to work. I mean, at one point or another, the credit cards are going to be maxed out, and the bank will say, well, I'm not lending you any money. So what are you going to do? Well, you're going to have to cut on your expenses. And probably that's your children allocation that piled up to like $5,000 a year now. It's probably the first place that you're going to cut off. So again, pretty obvious that something is going wrong here,
Mm-hmm.
even though amazing narrative, maybe or not. Crown Castle recently downgraded a DSR. It was like another bad quarter that came. FFO per share declined double digit. The revenue declined double digit. The dividend triangle is seriously weakening, and the company has stopped increasing its dividend in 2022. So while it was like a very interesting business model where they have like towers and cell data transfer, they are not able to make that as profitable as expected.
Mm-hmm.
So the dividend safety score got downgraded to a 2 not too long ago, and it's not looking that great for this one. So from a dividend, again, I'm always talking from a dividend growth investor's perspective. So maybe your goal is not to have dividend grower in your portfolio, and that's fine. Maybe you should not listen to what I have to say anyways, because you're not going to agree. But from my perspective, those companies that stop increasing their dividend, they're just one step away from becoming another Macerich, which if you look at the dividend triangle, it has been downhill since a while. The dividend was cut, the revenues are going down, and the stock price, of course, kind of follow pretty much the same trend. So I don't believe in major comebacks, so I rather go with like the safe stuff, because I don't think that BlackBerry and Nortel are going to be like among the best performer in 2025. So is Macerich.
All right, so Mike, the good news is there are still some good choices that would fit in a long-term investment strategy. In the US, you'd go for Realty Income, ticker is O, National Retail Properties REIT, NNN, and Vici Properties, Vici. What makes them potential buys?
Yeah, so of course, not all REITs are bad. I mean, it's the same thing for all sectors, right? And those that I've selected all have something in common. They grow their dividend. What a surprise. One thing that is interesting for Realty Income and National Retail Properties is their diversification and the fact that they focus on freestanding commercial properties. So it's, I guess, easier to manage. It increase your number of tenants and in like exposure to industries, so you're a little bit less exposed to a specific type of tenants or a specific tenants altogether. So for Realty Income, they have 86 industries renting their properties in many countries in Europe, on top of being obviously present in the US. They
Mhm.
show a very high occupancy level, and that provides them like predictable growth. So, of course, we're not talking about companies that will grow double digit here, but we're talking about companies that are actually delivering on their promise, a stable investment, generating a good yield, and increasing that payout every year so you don't suffer from inflation. So that's the
Mhm.
whole goal here. Um, National Retail Properties, NNN, they have increased their dividends since 1989. Kind of crazy, right? They acquire, they own, and they invest, develop their own properties. Again, single tenants focus. Their largest tenant is 7-Eleven with only 4% of their properties. So that's nothing. Even if,
Mhm.
7-Eleven, I mean, we had like some developments around Kushtar trying to buy them. That would be amazing. So Circle
Right.
K will become Circle 11, or we're gonna talk about seven circles. I don't know how they're gonna merge that, but anyways, that's another story. But only 4% exposure. Triple N has like 370 different tenants, 37 industries. So they have a similar business model than Realty Income, and it's probably explained why both of them are constant dividend growers. As for Vici Properties, it's a bit of a unique business model because they have like their properties are all about casinos. So it's very rare to see those like retail REITs that focus on this industry. It
Mhm.
could be risky on one side, but on the other, since there are not that many buyers to buy those properties, they could get good deals. Their contracts are often 40 to 50 years long because you
That's
can imagine that
amazing.
the Bellagio is not going to move anytime soon. So they're super happy to have like those long-term contract. Of course, it has like escalator clauses and stuff. So that's really interesting. And they have premium location. A lot of their casinos are in Las Vegas. So it's, of course, a play on the economy.
Mhm.
The unique business model could be like either a pro or a con depending on where you stand about casinos and Las Vegas. But still, I thought of mentioning this one because it offers a pretty interesting yield and increase its dividend pretty much every year.
On the Canadian market, City REIT, crt.un.to, Granite REIT, grt.un.to, and Interrent REIT, iip.un.to are the ones to buy. Why is it so?
Well, I tried to be original here and I failed, so I'm sorry, guys, but there are not many options here. And of course, I probably forgot like two or three REITs that are worth mentioning. But I decided to go with the classics just because the main focus here is to make sure it grows its distribution every year. So
Mhm.
for City REIT, of course, 97% of their properties are anchored by Canadian Tire. So it's definitely a play on Canadian Tire. You have to follow
Right.
both companies. That's probably the major downside as well. But they offer like 3 to 3.5% annualized dividend growth rate year after year, a healthy payout ratio, very stable business. Canadian Tire is an iconic brand in Canada, so it's not intouchable, but I'm not worried too much about this one. Not going to grow
Mhm.
super fast though, but again, we're talking about REITs. They're slow, they're boring. That's their goal. Granite, I have it in my portfolio. It's a very frustrating REIT to have because the
Right.
numbers are good, but the stock price just doesn't want to go up, and I'm just tired of that. But I mean, that's what it means to be patient and to be a patient investors, right? I'm not going to sell based on performance. So even though I'm roughly down, I don't know, like around 20%, not counting the dividends. So with the dividends, probably a lot less, but the stock price doesn't go up. It's down double digit in my portfolio, but funds from operation grows, funds from operation per share grows. The dividend increase about 3% every year. They show a low payout ratio. I'm not ready to let go yet. As long as the numbers are confirming my investment thesis, I'm not going to let the market decide. So I don't
Mm-hmm.
mind. I'm going to be patient. I'm going to cash in those dividends in the meantime, reallocating those amounts elsewhere. But I'm still positive on Granite, and I'm going to hold my ground until the FFO starts to go down. I mean, super high occupation rate as well. So all the numbers are good. So I'm just going to
Right.
wait. And to rent, they have apartment. It's an apartment REIT. They have apartment in British Columbia, Ontario, and Quebec. Their business model is all about buying undervalued properties, so like properties that lack of professional management. And so the goal here is to buy them, revamp the apartments and rent them at a higher price.
Mm-hmm.
They show a dividend increase rate of about 5% per year, so a lot more generous than the other two. If there's a housing crisis, well, people are going to go back to apartments, so kind of makes sense as well. They kind of target like middle to high class apartments as well, so that's great because it's probably easier to get paid every month.
Mm-hmm.
So that's another reason why I like IIP.
Now, what's the story around utilities? Why are they all down?
So it's not as bad as the other two industries, especially in the US. A lot of utilities are doing not so bad this year. It's worse for Canadian ones. And of course, when we're talking about those renewable energy utilities, a lot of them took a big hit. So there was a
Mm-hmm.
huge hype in 2021. It was like the next big thing. And then now it's definitely gone. And a lot of them struggles to generate more profit. So it's one thing when you get subsidies and everybody wants to give you money, so you just grow your solar panels and your wind farms. But then when the money gets dry, when it costs more to build those renewable energy stations and you get higher interest rates, well, it's kind of tough to convince investors that you're going to continue to grow.
Mm-hmm.
The other thing is also, as well is a lot of income seeking investors kind of left the building,
Right.
mostly because now they can find bonds and GICs paying 4 or 5% interest. So those were the same investors that moved away from fixed income and moved into higher yielding stocks, notably utilities, because they're stable and everybody needs power. So again, that kind of like common shortcut narrative where if you need power, obviously if you buy a utility stock, it's going to work out. It's not as simple as that. But yeah, so for all of those reasons, it has been very hard, but let's not forget that they benefited from a huge bull run for almost 10 years, where at one point it was kind of crazy where a lot of utilities, they were growing high single to double digit year after year, and they're not supposed to. They're supposed
Mm-hmm.
to be slow and boring like REITs. So we're kind of like paying the price for having that hype for so long as well. So it's just like going back to fair value, if I would say it that way.
Mm-hmm. Mike, we couldn't do this episode without talking about Algonquin, which has cut its dividend for a second time in like 3 years, I believe. So this one is just bad, right?
I mean, it's crazy. Yeah, I wanted to talk about Algonquin mostly because I wanted to put in perspective that after the dividend cut, it was actually at the beginning of 23. So time flies, but not that fast.
Mm,
So at the beginning in 22, they started to talk about like struggling with their numbers, and of
right.
course interest rates, like they most of their business model was based on variable interest rate on for their debt, so that blew up the entire balance sheet very quickly. So January of 23 they cut their dividend. That's a no-go for me, so I sold my shares the same day, took the loss, moved on. The point was, if I follow simple investment rules, it's easier to make decisions. I avoid the noise, I avoid dilemmas, and I just move on. So the faster I take the 50% loss on my investment, the better I felt. Because since then, I don't think about Algonquin anymore. I don't have this reminder in my brokerage account telling me that I'm in the red. And I just moved on to other better stocks and felt better about my investing strategy in my portfolio. But I know that a lot of investors held onto their shares
Right.
hoping it would recover. And of course, you're gonna talk about like one story where you hold onto a stock, it recovered and it felt good, and then you were right to not sell. Among dividend cutters, for each of those stories, I'll be able to provide you with dozens of stories where the company cut their dividend and never recover. So
Mhm.
it's not about, oh, yeah, but there is a chance. Of course, there is a chance. There's a chance that I win the lottery tomorrow morning as well. And I mean, that's a fact, unless I have to buy a lottery ticket, but that's another story. But the thing is, you have to put that into context. Why the company went wrong and what's going to happen next to recover. And unfortunately, they kept the same management that could not foresee the impact of interest rate on board, which now started to sell renewable assets. So their goal was to sell assets to pay down the debt, get a better balance sheet. They obviously don't do that enough or fast enough, or they're not competent enough to do it the right way. So they had to slash the dividend a second time to ensure that the company survived. Because keep in mind, the CEO and the management will always try to keep the business alive instead of keeping your paycheck alive. So unfortunately, they were bad back then. They're still bad today, and that's why the company keeps on going from bad news to bad news.
Listeners, I hope you enjoyed the episode so far, but I have to interrupt it a minute. Our goal at Dividend Stocks Rock is to help you invest with more conviction. We know that dividend income is important for you, and this is why we have gathered all you need to know about it in the Dividend Income for Life guide. Right, Mike?
Yes, I have a completely different approach when it comes down to generate dividend income, and I wanted to share my view with that. I wrote a series of DSR fundamental newsletters that were greatly appreciated by our members this year. I received tons of comments, and a lot of them were, Mike, you just came out with some very thought provocative concepts, and at this point, I really want to change my portfolio and follow this path to a better type of dividend income. So I've did a great review of those DSR fundamentals newsletters, packaged them together, wrote a few more pages of content, and built that dividend income for life.
This guide, as you said, has been highly rated by our DSR members, and we share it for free with you today. To grab your copy, hit pause on your app, visit thedividendguideblog.com/income, and enter your name and email. You'll then receive the email with your download. And also, by the way, it's always a pleasure to hear from you, so please let us know how it helped you. Again, thedividendguideblog.com/income. Okay, so other utility companies on the sell side are Suburban Propane Partners, SPH, Northland Power, NPI.to, and Interjex Renewable, INE.to. Why should investors wave them goodbye?
Well, let's start with Suburban Propane Partners. I mean, everybody needs propane. That kind of makes sense, right?
Mm.
Again, interesting investment thesis, very bad numbers. So, shaky dividend triangle, it's a serious dividend cutters. They cut their dividend more than once. So, let's just say stop hoping. It's not, that business model is not working. Like they just like prove it over and over and over again. Why would you keep up on this one? Just don't tell me the yield. That's not an investing strategy. Northland Power. A few years ago, a member asked me to compare Brookfield Renewable with Northland Power. And I came to that conclusion that, well, NPI is smaller, it has no growth, and it has a weak dividend triangle. I mean, no dividend growth since 2018. So you're less diversified, you're a smaller business, your dividend triangle doesn't go anywhere. try to convince me with the fact that I should buy this one, because that's, I'm sorry. And today I know I sound I don't know, blunt, I would put it that way. Probably that you'd like, of course, if you have shares of any of those companies that I'm destroying them live, you don't feel good. And I'm not trying to make fun of anyone, because I've made mistakes like this. I mean,
Mhm.
I had like VF Corporation, Silogist, Algonquin, all of those were dividend cutters, and I'm not proud of having those in my portfolio. But at that time when I decided to sell, I was blunt with myself. I'm like, Mike, you made a mistake. You didn't see that coming. That's on you. Now move on. So that's kind of like the service I'm trying to make today. So you can
Mhm.
hate me for doing it, but I'm just trying to highlight numbers and facts the way they are, and the way I should have seen it in my own portfolio for some companies that I didn't see that coming. I made those mistakes, and I'm trying for you to not make those the same mistakes.
Mhm. Mhm.
And speaking of mistakes, Interjex, that was another one a lot of investors had in their portfolio, because, again, very popular story where they are growing super fast in the renewable energy, and they were like showing great revenue growth. But then I rapidly warned investors at DSR, the dividend triangle is super shaky and the cash payout ratio is above 100%. Be careful. If the business is not able to generate enough profit to pay the dividend, and the cash payout ratio is above 100 for several quarters in a row, there's only one direction it's going to go. And unfortunately, Energex fell into that category where they cut their dividend because they simply didn't not have the cash flow to pay it.
Mhm. So let's move to some good news.
Yeah.
In the US, that actual context also made some candidates attractive. So, what would be the investment thesis for Xcel Energy, XEL, and American States Water, AWR?
Yeah, I just want to add a quick note that I would have added a Next Era Energy, but we just talked about it not too long ago on the show, so that's why,
Mhm.
again, trying to be diversified a little bit in the stock that we look into. So that's pretty much the only reason why it's not part of that segment. Excel Energy, electric and natural gas delivery company. They are present in Minnesota, South and North Dakota, Wisconsin, Michigan, Colorado, Texas, and Mexico. So, and I list up all the states because it's super important. Way they do it is they have been one of the largest renewable energy provider in the US. And what
Mhm.
they do is they focus on the state's strength. So they get the best wind. So they build the wind farm in Minnesota and Colorado. And well, you can guess that it's a little bit sunny in Texas and New Mexico, so they have solar panel. So I kind of like their geographic strategy here.
Right.
They've been doing great, 5 to 6% dividend growth rate, 3%, 3.6% yield. So a very stable and well diversified utility company using strengths of mother nature to keep on growing, and it's actually working, so that's also a good thing. Of course, we just had like a wildfire in Texas a few quarters ago, that rose a lot of concerns, and that is one of the kind of like the major risk for utilities these days. If they are responsible for those wildfires, it could like tumble very quickly. So fortunately,
Mhm.
they were insured. But again, want to highlight some risk. It's fun to be positive, but if you don't know about the risk, you may buy a stock that you're gonna like sooner or later discover something that you really didn't know about, and it's going to be a bad surprise. Um, American State Water (AWR). Regulated water utility. It will be the first or among the first dividend emperor, reaching like 100 years of consecutive dividend increase. I don't know if I'm making
Wow.
that up, but I mean, they're showing 71 years of consecutive dividend increases. Hard to beat, pretty hard to beat. So 75% of their business is regulated water services in California. So amazing state, flourishing economy. Most of your business is there. fragmented market on top of that. So growth, there's plenty of space for growth by acquisition there, and the rest of their business is to provide water and wastewater services to military bases. So again, super long-term contract, very stable type of business, and that kind of that's the reason why the stock is showing such a steady dividend growth rate, which is quite impressive. So AWR will not convince you with a small yield of 2%, but might convince you with an 7, 8, 9% dividend growth rate year after year, which is quite impressive once again. So for 71 years of dividend increase, high single digit, super stable business model in a great state. I mean, for me, it ticks all the boxes.
Okay, so Canadians also have good contenders in Capital Power, CPX.to, and Hydro One, H.to. Why do you like them, Mike?
Well, again, I have to put that small note, but there's a reason why I don't talk about the Brookfield or Fortis and so on. I discussed that with Vero, and we decided to go a little bit elsewhere. And I wanted to talk mostly about Hydro One because this is a company that we don't talk enough and flies under the radars. But let's start with CPX first. So Capital Power, growth by acquisition, greening process, sounds like Algonquin all over again. So are you going to fall for it again? I mean, maybe you should. As opposed to Algonquin, Capital Power, all their debt is with fixed interest rate. That's one major difference. The second one is their funds from operation per share is actually growing again, as opposed to AQN. So when you're thinking, oh, it's going to be Algonquin all over again, well, two major metrics are actually a lot better for CPX than AQN. So that explains why it should not likely going there. They continue to grow. They continue to diversify. One thing I didn't like about Capital Power a few years ago was the fact that they are highly exposed to Alberta. So nothing against Alberta, by the way, but I'm always a bit cautious about a utility stock or any company that focus on one single province. That would be a downside if there's if there's a recession in that province, it could be rougher. Now they are as they grow by acquisition, they diversify their business model. They are making acquisition in the US as well. So I kind of like where they are going. And again, as long as FFO per share is increasing here, I'm going to be happy to follow this one. I do not I have a super small position in my Smith Maneuver account, so it doesn't really count as a position in my portfolio, but an interesting play for sure. Now, Hydro One, and it's kind of ironic because I just said I don't like to be concentrated in one province. Well, Hydro One, you guessed it, pretty much just in Ontario. But the thing is, it's a bit different where they provide hydroelectricity. So it's a pure play on hydroelectricity on a well-diversified province. They offer a clockwork business model with cash flow growing, 5 to 6% dividend growth rate. And there's nothing else. There's nowhere else to go here. Hydro One is going to be there for decades, similar to what we have in Hydro-Quebec, where we live. But Hydro-Quebec is not public, and there was a lot of debate at one point to eventually let the government list and do an IPO for Hydro-Quebec for a part of it. This is exactly what the government of Ontario did. They still remain a large shareholders, so for the better or for the worse, it's up to you to decide, because they could have they could put some pressure on the company to not increase their rate to keep up with the economy. Same situation that we have with Hydro-Quebec here, where the government wants their dividend from Hydro-Quebec, but of course they're not going to want Hydro-Quebec to raise the prices too fast. So maybe it's going to be a problem for growth for Hydro One eventually. But in the meantime, the payout ratio is low. The business model, it could not be more rock solid than it is, and the dividend growth rate is there. So definitely a sleep well at night type of investment. So if you're looking for a new addition, I would start with digging on this one.
So, Mike, in the introduction, I said that at some point it can become confusing to choose between the ones to buy and the ones to sell. So let's make it clear. What are the big differences between the stocks to sell and the ones to buy? How can investors quickly identify them?
Well, what is great when you have a specific sector or an industry that is going down is the narrative is really bad. Like everything is like just bad news after bad news. The media is telling you that it's not going well. So all companies are put on the same basket, which is great for investors because that also means that some of them are actually good and
Hmm.
they will eventually recover because the narrative doesn't necessarily affect them. So how do you find those? Well, looking at the dividend triangle. So if the narrative is bad about like REITs, but you find a REIT where it keeps on growing their revenue, their FFO per share keeps on growing, and they keeps on increasing their dividend. The payout ratio is stable. Well, you probably found one of those companies that are worth your money. And yes, they are a victim of the bad feeling around the industry at this point. But
Hmm.
those things change so fast. I mean, on one year, you hate a stock, on the other year, you love a stock. That's how the market works. So if you focus on numbers and financial metrics, you're going to cut down that noise and say, you know what? I'm not going to give a value to one of my investment for the investment performance. So I don't care if it's up or if it's down, but I will give a value about the numbers. Is the company growing? Is it able to generate more profit in the future? And of course, is the dividend comes along. So
Hmm.
revenue growth, earnings growth, dividend growth. It's not that complicated when you think about that. But
Right.
when you're able to find positive dividend triangle among all of those companies that are struggling, chances are you probably have a winner there. But it also means that you will have to remain patient for a while. I mean, I'm still confident about Granite for those reasons, but in the meantime, there's not much I can do. So you just have to forget and just keep on moving with your strategy.
All right, thank you, Mike, for this deeper look on these tougher sectors and industries. Listeners, to create a sustainable source of income at retirement, download the free Dividend Income for Life guide at thedividendguideblog.com/income. For the show notes and related content, visit thedividendguideblog.com/191. Also, do not leave without subscribing to the show and leaving us a 5-star rating. This helps us reach a broader audience of investors just like you. Until next week,
Stay
stay
invested.
invested.
Hey, fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.